Trading the Santa Claus Rally. The Santa Rally refers to a tendency for stock markets, particularly U.S. equity markets, to rise during the final trading days of December and the first few trading days of January. Traditionally, the Santa Rally is defined as the last 5 trading days of December plus the first 2 trading days of January, a total of 7 trading sessions. During this short window, markets have historically shown a bullish bias more often than not. The term itself was popularized in the 1970s by Yale Hirsch, the creator of the Stock Trader's Almanac. Hirsch observed that markets frequently posted gains during this specific time period, prompting the festive nickname. Over time, the Santa Rally has become a widely followed seasonal pattern discussed across trading desks, financial media, and retail trading communities. What makes the Santa Rally particularly interesting is that it does not rely on a single technical indicator or macroeconomic report. Instead, it emerges from a combination of market structure, institutional behavior, investor psychology, and calendar effects, all converging at the end of the year. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmentees.com and use the code BLOG to receive 25% off your next purchase. When traders discuss seasonal patterns, skepticism is healthy. However, the Santa Rally stands out because of its long-term historical consistency. Over many decades, U.S. equity indices such as the S&P 500, Dow Jones Industrial Average, and Nasdaq Composite have shown a statistically positive bias during the Santa Rally window. Historically, markets have closed higher during this period roughly 70% to 80% of the time, depending on the index and the time frame studied. While the average gain during the Santa Rally is not massive, it is notable because it occurs over a very short time span. Even modest percentage gains can be attractive to traders when combined with tight risk management and favorable probability. That said, it is critical to understand that no seasonal pattern works every year. There have been years where markets declined during the Santa Rally window due to macro shocks, financial crises, or unexpected geopolitical events. The Santa Rally is best viewed as a probabilistic edge, not a guaranteed outcome. The reasons behind the Santa Rally are multifaceted, and no single explanation fully accounts for the phenomenon. Instead, it is the interaction of several forces that tends to push prices higher toward year-end. One major factor is institutional portfolio positioning. As the year comes to a close, fund managers often engage in window dressing, a practice where they adjust portfolios to showcase stronger performing stocks in year-end reports. This behavior can increase demand for equities, particularly large-cap stocks. Another important driver is reduced trading volume. During the holiday season, many institutional traders and market makers take time off, leading to thinner liquidity. In low-volume environments, markets can drift upward more easily if selling pressure is muted. Investor psychology also plays a crucial role. The end of the year is associated with optimism, bonuses, tax planning, and fresh capital allocation for the new year. This optimistic sentiment often spills into markets, reinforcing bullish behavior. Finally, tax-related activity contributes to the setup. Earlier in December, investors may sell losing positions for tax loss harvesting purposes. Once that selling pressure subsides, markets can rebound, creating a favorable environment for a late December rally. Market psychology is an underrated but essential component of the Santa Rally. Traders are not robots. They're humans influenced by emotions, expectations, and social narratives. The idea of a year-end rally becomes somewhat self-reinforcing as more traders anticipate it. When enough market participants expect higher prices, positioning shifts accordingly. Short sellers reduce exposure, long-only investors increase allocations, and momentum traders look for breakout opportunities. This collective behavior can amplify even small price movements, especially during periods of low liquidity. The Santa rally also benefits from a psychological reset. As one year ends and another begins, traders are more willing to take on risk, especially after closing the books on the previous year. This renewed risk appetite often favors equities over defensive assets. While the Santa rally is most commonly associated with U.S. stock indices, its influence can extend to other markets as well. The S&P 500 and Dow Jones Industrial Average are typically the primary beneficiaries, given their heavy institutional participation and broad market exposure. The Nasdaq often shows even stronger performance during bullish Santa rally periods, particularly in years where technology stocks are already in an uptrend. Small-cap stocks can also outperform during this window, as traders rotate into higher beta assets. Outside of equities, the Santa rally effect is less consistent. Some years see strength in cryptocurrencies, particularly Bitcoin, as speculative appetite increases. However, these moves are more sentiment-driven and less statistically reliable than in traditional equity markets. An often overlooked aspect of the Santa rally is what happens when it does not occur. Historically, the absence of a Santa rally has sometimes been interpreted as a warning sign for the broader market in the year ahead. When markets fail to rally during this seasonal window, it may signal underlying weakness, elevated macro risk, or deteriorating investor confidence. Traders who monitor the Santa rally often use it as a sentiment gauge rather than a standalone trading signal. It is important not to overreact, but professional traders respect the information embedded in seasonal failures. A weak or negative Santa rally can encourage more defensive positioning in early January. There is a meaningful distinction between trading the Santa rally and investing around it. Long-term investors may simply maintain or slightly increase equity exposure toward year-end, trusting the long-term upward bias of markets. Traders, on the other hand, seek to capitalize on the short-term price movement associated with the Santa rally. This involves precise timing, defined risk, and a clear exit plan. Trading the Santa rally is less about predicting the future and more about exploiting a temporary statistical edge. To truly understand how traders can profit from the Santa rally, it is essential to walk through a detailed, realistic strategy example. This is not financial advice, but an educational framework illustrating how professional traders might approach the opportunity. Imagine a trader focusing on the S&P 500 index via an ETF, such as SPY. The broader market has been in a steady uptrend throughout the year, making higher highs and higher lows on the daily chart. As mid-December approaches, the trader begins monitoring price behavior more closely. The first step is context analysis. The trader confirms that the market is above its 50-day and 200-day moving averages, signaling a bullish longer-term trend. Volatility has been declining, and there are no major economic releases scheduled during the final week of December. This creates a favorable backdrop. Next comes timing the entry. Rather than entering blindly, the trader waits for a mild pullback or consolidation during the third week of December. This pause often occurs as traders finalize tax loss harvesting. Once selling pressure fades and price begins to stabilize, the trader looks for a daily close above a short-term resistance level. When the breakout occurs, ideally accompanied by modest volume expansion, the trader enters a long position. Risk is clearly defined using a stop loss placed below the recent swing low or consolidation range. This ensures that if the Santa rally fails, losses are controlled. The profit target is based on prior resistance levels, recent volatility, and average Santa rally performance. The trader may aim for a gain of 1 to 2% over the 7 trading day window, which is realistic for a broad index in a short time frame. As the trade progresses, the trader actively manages risk. If price moves favorably, the stop loss is trailed higher to protect profits. If price stalls or reverses sharply, the trader exits without hesitation. discipline is the key differentiator between successful and unsuccessful Santa rally trades. This example highlights an important truth: profitable Santa rally trading is not about predicting magic outcomes. It is about aligning seasonal bias with trend confirmation, risk management, and execution discipline. Even during historically favorable periods, risk management remains paramount. The Santa rally's short duration means that traders do not have much time to recover from poor entries or oversized positions. Professional traders typically reduce position size during holiday periods due to thinner liquidity. They also avoid overleveraging, recognizing that unexpected news can still move markets sharply even when volume is low. Stops are non-negotiable. A Santa rally trade without a predefined exit is speculation, not strategy. By keeping losses small, traders ensure that a failed seasonal pattern does not derail overall performance. One of the most common mistakes is assuming that the Santa rally is guaranteed. Traders who enter positions too early, too late, or without confirmation often experience unnecessary losses. Another frequent error is ignoring broader market conditions. The Santa rally tends to perform best in markets that are already trending higher. Trying to force a Santa rally trade during a strong bear market dramatically reduces the probability of success. Overtrading is also an issue. Because the Santa rally is widely discussed, some traders take multiple impulsive trades instead of one well-planned position. Patience and selectivity matter more than frequency. The Santa rally is often confused with the January effect, another seasonal phenomenon where small-cap stocks tend to outperform in early January. While the two can overlap, they are distinct patterns driven by different mechanisms. The Santa rally focuses on year-end optimism and institutional behavior, while the January effect is more closely linked to capital reallocation and tax-related flows at the start of the new year. Understanding this distinction helps traders avoid conflating separate strategies. In an era of algorithmic trading, global markets, and real-time information, some traders question whether the Santa rally still holds relevance. Interestingly, while returns may be smaller than in decades past, the directional bias has remained surprisingly resilient. Markets evolve, but human behavior changes slowly. As long as institutions report annually, investors plan taxes, and traders respond to seasonal narratives, patterns like the Santa rally are likely to persist in some form. That said, adaptability is key. Traders should treat the Santa rally as a contextual edge, not a rigid rule. Conclusion: the Santa rally is more than a catchy market phrase. It is a historically observable seasonal tendency that reflects the intersection of market structure, psychology, and institutional behavior. While it does not guarantee profits, it offers traders a probabilistic advantage when approached with discipline and realism. By understanding what the Santa rally is, why it happens, and how to trade it responsibly, traders can add another tool to their strategic arsenal. The key lies in aligning seasonal bias with broader trends, managing risk carefully, and maintaining emotional discipline. In the end, successful Santa rally trading is not about believing in holiday magic. It is about respecting probabilities, executing a plan, and staying consistent. When approached correctly, the Santa rally can be a valuable opportunity rather than just a seasonal market myth. Thank you for watching.